Let's start with a question. Is Bitcoin still an opportunity? Or did you miss it? Some people think it's too late. Others think it's inevitable. Some call it digital gold. Others call it a bubble. But here's the reality. Bitcoin is no longer a niche experiment. It's no longer underground. It's no longer ignored. But it's also not fully understood. Today, we're breaking down Bitcoin in 2026. What it actually is, why it exists, why institutions care, where the real risk is, and whether it still makes sense strategically. No hype, no price predictions, just structure. To understand Bitcoin, you need to understand money. Traditional money has three core problems. It can be printed infinitely, it depends on centralized control, it loses purchasing power over time. Bitcoin was created as a response. Fixed supply, 21 million coins, no central authority, global accessibility, transparent monetary policy. It's not just an asset, it's a monetary experiment, and experiments like this don't happen often. Bitcoin's power isn't speed, it isn't flashy technology, it's scarcity. Only 21 million will ever exist. No central bank can change that. No government can inflate it. That makes Bitcoin fundamentally different from fiat currency. Scarcity creates predictability. Predictability creates trust. Trust creates value. But scarcity alone isn't enough. Adoption matters. Early Bitcoin was retail-driven. Now, institutional money is involved. ETFs, public companies holding reserves, nation-state interest, financial products built around it. That changes liquidity. It changes perception. It changes volatility patterns. Bitcoin is no longer fringe, it's integrated. But integration brings a new question. Does institutionalization reduce upside or legitimize the asset? Bitcoin is volatile. It always has been. 30% corrections, 50% drawdowns, 80% bear markets. This isn't new. Volatility is the cost of asymmetric upside, but volatility destroys weak conviction. If you don't understand what you own, you will sell at the worst time. Bitcoin rewards patience, conviction, time horizon, not emotion. Compare Bitcoin to stocks, real estate, bonds, gold. Stocks generate cash flow. Real estate generates rent. Bonds generate yield. Gold preserves value historically. Bitcoin? It generates nothing. It relies on adoption, scarcity narrative, network effect. That makes it fundamentally different. It's a non-yielding, scarce digital asset, which means position sizing matters. Zoom out. Ignore weekly price swings. Over 10+ year periods, Bitcoin has outperformed nearly every asset class. But past performance doesn't guarantee future returns. As the asset grows larger, growth rates naturally slow. You can't expect 100x from trillion-dollar assets. The question becomes, is Bitcoin digital gold, or is it speculative tech? That distinction matters for expectations. Bitcoin thrives in high inflation environments, currency debasement, capital control fears, monetary instability. When trust in fiat weakens, interest in Bitcoin increases. But when liquidity tightens, speculative assets suffer. Bitcoin exists inside the macro cycle. It's not isolated. Understanding macro improves Bitcoin's strategy. Bitcoin has a predictable issuance schedule. Every 4 years, mining rewards are cut in half. This reduces new supply entering the market. Historically, halvings have preceded bull cycles, but markets mature. Patterns weaken over time. Blindly expecting repetition is dangerous. Understanding structure is smarter. Let's talk honestly. Bitcoin risks include regulatory crackdowns, severe taxation changes, technological disruption, competing digital currencies, liquidity crises, security failures, custody risk. You must evaluate these risks calmly. Bitcoin is asymmetric. But asymmetric cuts both ways. Bitcoin attracts extremes: maximalists, deniers, speculators, long-term holders. The biggest mistake? Treating it like a guaranteed outcome. The second biggest mistake? Ignoring it entirely. Both extremes lack balance. Rational allocation beats emotional conviction. If Bitcoin goes to zero, does it destroy you? If Bitcoin 5x's, does it meaningfully impact you? Position sizing determines whether it's speculation or strategy. For many investors, 1% to 5% allocation reduces regret risk. For higher conviction investors, larger allocations come with higher volatility tolerance. Bitcoin should not replace diversification. It should complement it. Bitcoin moves in cycles: euphoria, media hype, retail rush, blow-off top, bear market, silence, accumulation, repeat. The real money historically has been made during boredom, not euphoria. Buying during hype feels exciting. Buying during fear feels uncomfortable. Wealth often lives in discomfort. The long-term thesis for Bitcoin is simple: fixed supply in an inflationary world, digital store value, borderless, permissionless money. The counter-thesis: volatility, regulatory risk, lack of intrinsic yield. Both can be true. The market decides which dominates over time. Bitcoin is no longer experimental. It's no longer invisible, but it's still early in global adoption compared to traditional asset classes. Whether it becomes digital gold, global reserve asset, or just a volatile store of value depends on adoption trajectory and macroeconomic stability. Bitcoin is not magic. It's not guaranteed. It's not a shortcut. It's a high-volatility, scarce digital asset with asymmetric potential. If you understand it, it can be strategic. If you don't, it can be dangerous. The question isn't, will Bitcoin go up? The real question is, do you understand what you're holding? Because conviction without understanding is gambling, and strategy without emotion is investing. This video is for educational and informational purposes only. It is not financial advice. I am not a financial advisor. Always consult a qualified professional before making major financial decisions. Are you allocating to Bitcoin or staying completely out? Comment below. And if you want more rational, hype-free breakdowns of money, markets, and long-term strategy, subscribe. We don't chase narratives. We analyze structure. See you in the next one.